Hey everybody, welcome to Trading Capital's daily analysis video here on June 14th. And what an epic day in the markets, especially for some of our positions. We have banked profits, and this is why you got to trust the technicals, and accompanied by a fundamental analysis of the larger macroeconomics at play. We are proving to be crushing 2022 with the profits that we are generating. When most funds are down on the year 20, 30, 40%. I was in Toronto on the weekend, and I was talking to a fund manager in Toronto that manages $3 billion in assets under management, all mutual funds and securities, and they are down 30% on the year. This is supposed to be professional traders and investors that know how to manage risk appropriately and are supposed to have the leading cutting edge research and insights into what the markets are likely to do. And you're down 30%. The $3 billion under asset management is no longer the $3 billion that it once was. But that's just a tip of the iceberg that funds are starting to experience, and why I do think this debt crisis will get worse as funds are over leveraged in specific sectors and trades. And I just want to congratulate you all on the profits that we banked today. We covered our UNG short. We'll touch base on natural gas. What an epic sell-off on natural gas. People are still calling for UNG to hit 50. That is absolute lunacy. When you factor in the biggest driver for natural gas is not a war, not a supply chain disruptions. It's simply the biggest driver for natural gas is going to be economic GDP output, whether it's increasing or decreasing. And that's certainly where we're heading with the longer term picture over the next several months and couple quarters, is declining and contracting GDP, starting with most likely the Eurozone, then facilitating to America, and then facilitating to Canada. But overall, the GDP forecasts are being sliced due to the fact that GDP numbers have been artificially propped up for the last few years. And arguably, GDP numbers have been propped up for the last 50 years, with mortgage rates being artificially suppressed and the amount of expansion in the money supply on a year-over-year basis is just absolutely crazy. And that's certainly propping up the overall GDP numbers that we've been experiencing for many, many years. But nonetheless, natural gas, we covered our UNG short. I believe in the chat I put a profit of 20%. That was actually incorrect. It was just under 15% that we banked on that trade. I did have a secondary trade account where I was shorting UNG around $30 level here, which is why I got my percentage profit a little bit skewed. But still, nonetheless, we banked 14.82% on that trade. So congratulations if you took that with me. We're still holding our KOLD because I do think energies go lower. It is a strong asset class, so to speak, but I do think that the overall macro trend will prevail. It will trump the supply chain issues because GDP growth ultimately drives the amount of demand. And if you have a weakening demand, which is what we here at Trading Capital think, the demand will overall supersede any of the other microeconomic factors that are at play. So it's very, very incredible to see how quickly energies can and will collapse in a weakening economy. We even got a beautiful reversal signal on oil, a beautiful topping tail. So we'll just have to continue to see if we get further downside in energies. But nonetheless, we covered that UNG for beautiful 14.82%. Congratulations on the Johnson & Johnson short. We also covered that today for a lovely 9.78% gain. And then we were busy as well. We did add to our couple longs. So we basically closed out a couple shorts today, and we did add a position, just some small amounts to our longs. We added a little bit to our LYFT position at 0.7% add. So it was a very smaller addition than what we usually do, just because there is tremendous risk with us heading into the Fed meeting. But I do think markets are getting to those oversold levels where we still could have a technical bounce despite rates surging and despite the sentiment still being so bearish. We do have to keep in mind this is options X week, quadruple witching week, which means 4 asset classes roll over and expire. So there could be a lot of price manipulation. And the amount of puts on this market is unbelievably high. The put to call ratio is drastically in favor of puts, which means that the herd mentality thinks the market is going lower. And generally, when you have the herd mentality on one side of the fence, that's when the markets kind of flip-flop to the other side. So that's why I want to pare back some of our short exposure. We still have quality short names which are in the money on, and I expect some to continue to fall even more. But I do at the same time like accumulating some of those longs because many names are at depressed key support technical levels, which still do favor a mean reversion bounce of some sort. It's just whether or not, when are the markets going to get that mean reversion bounce? We've had 4 hard trading days of selling. Roughly in 4 days, the S&P has fallen just above 10%. So that's a substantial move to the downside, and we are heading into some support levels. I do think the S&P is at a very close buying opportunity for a swing tradable bounce, a bounce that's all it will be, as I do think over time we still see another 20 to 25% haircut on the S&P 500. So looking at natural gas, I just want to bring up the actual natural gas chart. Look at this impeccable sell. And this came on the news that the LNG terminal in Texas is, originally it was supposed to be closed for 3 weeks, but apparently it's now only going to reopen within 3 to 6 months. So this 3 to 6 months is going to give us an epic time frame, in my opinion, for natural gas to head lower. And on a daily chart basis, you've sliced through now the 25-day moving average. Today you sliced through the 50-day moving average. What we're going to look for tomorrow is confirmation below this 50-day moving average. There is the chance that you can retrace back to the 50-day moving average, which would be the 783 mark. But there's still so much technical damage that was done today that I do think you have hit the support level here at 712. The next big support level is going to be your 650 area. And I do think with the backdrop now that the second largest LNG terminal in Texas is now potentially being closed at the minimum for 3 months and at the worst case for 6 months, we could see natural gas start to slice through those key support levels like a knife through butter. And just to put into perspective, right now the natural gas has fallen from the high. It's reversed down, now 18%. Now we still have about 36 minutes left on this daily candle for natural gas, but falling 18% on a daily close, this is going to potentially be, right now, it's the third largest reversal daily close in natural gas price history. Third largest reversal. You had a massive mega day reversal, and I'm judging this on a daily close basis. So if natural gas somehow popped up, it would obviously take that statistic away. But if it falls lower, it could bump it up into the second place, the second biggest reversal. So you had a massive reversal in natural gas on a daily closing basis. You had a 27.9% reversal from the high to the close in February of 2003. And then your second largest reversal day, sell side pressure, was in November of 2018 when you had from the high to the close, you had a 19.16% drawdown. So you can see we're almost at the second largest reversal day in natural gas price history. And that is telling you something, that massive sellers are finally liquidating their position, and it is coinciding with a weakening economy worldwide. And I feel very sad for Europe because the declines that we're experiencing, they're most likely experiencing the inclines because the amount of natural gas that we've shipped to Europe, they have been so heavily dependent on US LNG products being shipped there that they're certainly going to be hit hard with this delay in the LNG terminal in Texas. So we'll just have to keep monitoring that. But I do think we're primed and now ready to finally profit on our natural gas trade. Just keep in mind, this is still one of the leading sectors, energy. So there's still going to be buy the dip mentalities as people are still going to look to park long-term capital in what's potentially going to still be considered a safer asset relative to the stock market, the rest of the equities and tech. So there could be some bounces along the way, but the technical damage is done. We were calling for this bearish inside bar consolidation to break, and we got a terrific break. And I'm just so happy to report that I think we're finally on our way to having natural gas close a lot lower in the coming weeks and months. And ultimately, since you've sliced through the support, you will have support down here. But I do think you test the low range of this channel now at the minimum with that superb closure in the LNG. It's going to provide an amazing stockpiling backdrop for all of the U.S. reserves and North American reserves. So roughly 2 billion cubic feet a day in natural gas that could be built. So you times that by 5 per day, that's 10 billion cubic feet. You factor that over a 3-month period, which is basically 4 weeks, so 20 days. So, we're calling it 120 billion cubic feet extra at the minimum that is going to be stockpiled in our reserves. That's ultimately going to drive the price down of natural gas here in North America. Unfortunately not in Europe, but definitely here in North America. Since we're on energy, I want to bring the US oil chart WTI into the equation. Look at this beautiful reversal. So you've had this reversal candle. The beautiful thing is that you've hit your support here, your original zone that you broke out of. Now the question is this going to be the start of a falling energy price? Or is this just your check back to the breakout zone here and then pushing up to new highs? I'm in the camp that with the Fed releasing GDP forecast tomorrow, I do think the SEP estimates are going to be revised down. I think the growth is going to be very grim and bleak, and hence the reason energies are sensing some weakness today. I do think smart money is now pricing in a slowing global economy, which inevitably is the biggest driver for energies. And that's the beautiful thing, is that in 08, you had a 9-month window where the S&P topped in 2008, and oil proceeded to rally for an additional 9 months before the inevitable collapse. And energies, believe it or not, made a bottom before the equities did, despite they started falling 9 months later. So currently we are approaching month 5. The S&P topped on January 4th, the Nasdaq topped mid-November. So we're approaching now, starting from the S&P top, a 5-month window that oil has been rallying as equities sell off. So historically speaking, I don't think this cycle is going to be much different, despite many bulls and energy bulls claiming that the supply for oil is massively underfunded and the investment is massively underfunded. I do agree that it is, on a fundamental basis, a complete shortfall in the energy policies at work by the Democratic Party in the US is completely atrocious and creating higher energy prices. But the one simple fact that we here at Trading Capital believe is that the larger macroeconomic factor at bay, which is quantitative tightening and reducing the money supply, is essentially the bigger macro factor that will take hold. You can have supply chain disruptions which factor into higher energy prices. You can have the inflation. But overall, in a tightening cycle, the central bank policy kills demand. And ultimately, one of the reasons why oil continues to rise drastically is because there's not enough supply and there's too much demand. Well, as demand falls, I do think it comes more in line with the regular supply levels that we should be able to meet over the course of a period. Because when you factor in, especially the last 2 years, if you're using averages in the oil industry for the last 2 years, they're completely skewed, because we've printed the most money in the last 2-year period than we have ever done in our history. And then even if you expand that horizon to a 5-year period, a 10-year period, the 2008 crisis, or even the 2000 dot-com bubble, when we started QE in the year 2000 and then accelerated in 2008, all of these averages have been artificially skewed and propped up by zero interest rate policy, the ZIRP program, and free liquidity. So in reality, if we go back to a true demand, it's very difficult to pinpoint where that demand is, but I know it's lower because the money supply has expanded so drastically. But now we're having to fight inflation, and that is going to be the main aspect that central bank policy has to focus on and really destroy with higher rates and quantitative tightening. Now, how successful are they going to be? I don't think they're going to solve this issue very quickly, because ultimately they do want inflation, which is going to inevitably wipe away some of the debt load. So let's just monitor oil. It is beautiful that we have this reversal signal. If we go to the USO chart, because we are short the SCO, you can see again, we failed to take out this high on the USO, and now we're reversing. So that's a pretty substantial move down. If you also look at the XLE chart, energy chart has, let me flip to a weekly basis, has beautifully hit off that trend line of resistance. The only thing I'm disappointed is that we didn't short it, but we are shorting energies with many other names such as CVE, PXD, Valero, obviously short natural gas and oil. So I think we have enough exposure to the energy market. But just to put in perspective on a weekly basis, look at this sell-off, and this beautiful weekly topping tail is a thing of beauty. It truly is a magnificent rally and then reversal, which engulfed this candle on a closing basis. And now you're starting to put in some sell side pressure. And on a short-term basis, you're now teetering with this 25-day moving average. And notice how on the previous occasions, every time you teetered with it, you closed over here, rallied, you were rallied above it. So the trading sessions ahead of us are going to be pivotal. There is a chance that we come back up here to fill this key gap fill, but I'm in the camp we have put in a cycle top in energy, and I think the GDP numbers are going to come in very, very bleak, and especially as we head into that mid-July month when we actually get the GDP numbers for the US, I still think there's a high probability of a contraction, or certainly a worse number than the market is expecting, which could inevitably send this market to the next lower level. So let's take a look at the S&P 500. S&P 500 has had another down day. When you factor in, you're on 1, 2, 3, 4, 5 days of downside pressure. So that's a thing of beauty to see. I have a couple different key parallel channels that we're watching. So originally this was your channel that you were trading in. Now that you've broken and you did not confirm below, it was close to a confirmation signal, but you did not get that since you closed within the wick of this lower candle. So since you're still holding that candle, we're just going to have to see and wait for another potential move. I'm very close to buying some of the S&P 500 here as a potential long trade, but I want to see it fall a little bit more. My first buy level, inching in for a swing trade, will be around this 367 or a pierce of 367. So I do think we could see another flush out, and I want to see another flush out because then we'll be on a technical time count of a 6-day surge down to a low. Statistically, whenever you have 6 down days in a row, there's a likelihood of a bounce. So I'm waiting for that extra technical factor. Then you also have this longer term channel that's coming into play. You can see it connects basically all the way going back to the 2018 highs over here before you had your collapse. And this was your level of support on many different occasions. And then you have your pre-COVID high, your pre-COVID low. So I do think this channel is going to act as a good support level, potential tradable bounce as you flush down into it. You should get a bounce around that 365 level, 364 give or take. But I think we have formed now a new parallel channel, which is a strong potential that we continue selling in. So I think buying at the low end of this channel range is going to be a safe bet as a swing trader. And as you can see, we are only really in the center point of this channel. So it arguably states that we could see another 8% downside over the coming weeks to take the S&P much, much lower into the support zone. But I do think this will be an interesting channel to watch to see if we potentially bounce back and forth as if we did here. But notice the degree of the angle is a steeper downtrend. That's because the underlying fundamentals of this economy, not just the US, the whole global economy, is weakening. If we flip to the daily chart, you did have a little bit of buying pressure into the end of the day, but you're still stuck under these key moving averages. And you can simply draw a trend line across here. Oh, let me just correct that. And you can see why it's been resistance. You know, you have a pivot high here, major pivot here, pivot over here, and now you hit this and you've pulled off. But this is a short-term bull flag pattern. You have this inside bar intraday consolidation that is occurring, and the markets are oversold. So there is a potential that we get the bounce. And again, the sentiment is so bearish out there once again that I think the reason you're seeing the sentiment indicator in the put to call ratio on the markets. There's a lot more puts on the market, which is why I do think we have the potential to float up. And that's one of the reasons I'm accumulating more longs, just slowly, like PayPal, HCA. We also did another Canopy Growth edition. We did short LI today, which I'll go over, but there's certain names that we are accumulating because I do think the markets can get that inevitable bounce. If you look at the NASDAQ is kind of in a similar boat. You have pierced this channel, but you did not confirm yet. So on a technical basis, we are waiting for confirmation break in this channel of support. So until we get confirmation, we have to still technically assume this channel's in effect as support, and it's likely to favor a move up. But with the Fed meeting, if they do a 75 basis point hike, I do think we see another flush down and then potentially reversal. The markets have already priced in the Fed raising rates by 0.75, so 3/4 basis point hike. But I still think they're going to stick to 0.5% basis point hike. If the markets get that 0.75 basis point hike, I think they sell off a little more, taking us lower. But if we get that 0.5% hike, I think the markets can stage a little bit of a relief rally to negate some of this downside pressure. But nonetheless, the overall sentiment is bearish. Markets are weak. There's lots of catalysts that could come at play. We could arguably be in the early initial stages of a crash. We could look back at this period as a crash. And the interesting thing is we were informing our members. I was talking about this for a couple weeks in a few of our videos over the last, our daily wrap-up videos over the last several trading weeks and months. Is I was making a point, especially on the S&P 500 daily chart, that we had a series of 1, 2, 3, 4 lower highs in the trend, just like we did in 08 and just like we did in 2000. You made 4 lower highs, and then after the 4th lower high, a crash proceeded. And one can argue this is the start of a crash. You've had a 10% down move in essentially 1, 2, 3, 4 trading sessions. If we get more continued downside, this will constitute a market crash, and it could potentially signal the algorithms to just sell anything and everything. Doesn't matter what they want to sell, it's what can I sell in this market environment. So we'll just have to continue to watch and see. I do think we're positioned either way. If we get that bounce, we'll profit greatly from our longs. The overall trend is down, so I do think our shorts will profit tremendously. We are in the money on many of our shorts, so to speak, but I do think I want to see a technical bounce in the markets, which will give us the ability to offload some of that long exposure that we have been accumulating over the last several trading weeks, and we'll just have to keep monitoring that by ear. Another interesting chart is the IYR. If we flip to the daily chart, IYR saw another down day, so now it's down 25% from its highs. Typically, the IYR ETF lags the physical real estate by 6 to 12 months. So the fact that we put in the top at the beginning of January, 5 months ago, you should start seeing cracks in the real estate sector appearing faster and harder than we have witnessed in a very, very long time. And the fact that the IYR is cracking, and you also have lumber cracking, the lumber to gold ratio is a good metric to basically figure out. It's a good indicator that just generally displays a crashing real estate market as that ratio gets weaker. So all the metrics, all the signals, all the data is starting to point to a massive decline in real estate. And I do think at the minimum we see a physical price decline of 25%. But at the base case worst scenario, I could see a 40% decline in a physical real estate markets. Obviously, the income producing properties like rental properties, specifically catering to the student market, and I've managed 70 properties here in Canada, and I'm very exposed to the real estate market. And essentially, the income producing properties will be the best properties to hold on to, and they will offset that risk, that potential asset or that potential valuation decline. They will get hit, so to some extent, but they will be the least hit and they will be the last hit. So I always refer to that as the double L, the income producing properties, so the rental properties, and you have to be very, very careful which market you're in. I specifically only cater and would invest in the student market because students typically have wealthier moms and dads, whereas if you're catering towards the professionals who potentially lose their job at the end of the tightening cycle and can't afford their rent, they're more exposed to one single family dependent losing their job, as opposed to the university students and the college students that get help from the parents and have OSAP or student aid programs or loans that banks give to help fund their student endeavors. So we'll just have to continue to monitor the real estate because it is going to be a leading indicator as to where the overall economy goes. If we take a look at some of the positions that we did do today, so we added to our LYFT today. The reason we added to LYFT was you're into this major COVID low bottom. So it's beautiful to see that you've done a full round trip of the bubble, negated the whole QE bubble, and now you're into some massive technical support. If you flip to the weekly basis, you've had this massive decline. You've had a 1, 2, 3, 4, 5, 6, 7, 8, 9 weeks, 8 out of 9 weeks of sell side pressure into support. I do think you've had your major capitulation bar, which is this down candle here. And I do think that LYFT will get an inevitable bounce with the markets as it is completely oversold, and it is trading now at the lowest level in its price history. Now, it does have a very small track record, but the fact that it's trading at its lowest level and we own it at its lowest level, and it's at the COVID massacre bottom when the economy is still technically running smoother than it was during the lockdowns, I do find this a great mean reversion candidate. We also added to our CGC a very small ad. I do want to increase my exposure to Canopy growth. Our average, funny enough, with the ad is sitting at 420, so it was only a 0.5% ad around the 336 mark over here. But I do think we're getting to some sort of a mean reversion bounce in the overall cannabis sector due to the fact that you're into massive technical support. So let me just show you these support levels here. Let me just remove this here. So here was your original volume breakout bar, and this is the area that you're now into. You made a low and you pretty much tagged that to a T, these highs here. So you are into tons of support. This was your crazy mania phase, and you're now trading below IPO levels. So that's another interesting factor to me, that Canopy growth could be a potential buyout for Constellation Brands. I still think there could be some sort of a deal in the works with a bigger player coming into the Bay, especially as the midterm elections approach in November in the States. There's going to be that chatter nonetheless from politicians to try to sway voters to their side. As we all know, the statistics in the US now, 80% of Americans are now have polled that they support legalization of recreational and medicinal marijuana. So there's a huge push already in the states for medicinal legalization. Obviously, many states have recreational legalized as well, but not the majority yet. But when the majority of the population is in favor for it, it's not long after that scenario takes hold. We also shorted a new position today, ISRG. So we went long ISRG. The reason I like ISRG is because it's a strong blue chip company, and essentially it's on this 1, 2, 3, 4, 5 days of sell side pressure. You can see you have this first trend line of support that we hit, as well as you're into some massive technical area here. You did fill on a daily basis this gap fill that I've been eyeing up for quite a long time. So it's good to see that we're now accumulating yet again another quality name coming into oversold levels. If we flip to the weekly chart, you can see you're into tons of support, pivot top, breakout zone. It is a small position, and I'm willing to add to this position at key levels around this 182 level. I am prepared to take this up to 5% of our portfolio, as it is a very safe place, so to speak. But even if you look at the monthly chart, just to see this oversold nature, it's very rare that you have this bear flag breakdown and you've actually completed the fully measured move of this bear flag. So now the fact that you've completed this fully measured move, you've had 3 months of downside pressure, and realistically, if you go back on the charts, it's very hard to find 3 months of sell side pressure in the magnitude that you've sold. So even with the COVID collapse here, you had 1, 2, 3 months of hard selling. Here you've had 3 months of hard selling, completed the bear flag move into support. So there's tons of technical factors here, and I do think we should get that bounce, as it is a quality name paying a dividend, and I'm not too worried about holding this one over the next say 1 to 3 months if we have to stay in that trade that long. We also added a short position to our portfolio. So LI Auto, one of the reasons I've added a short to this is you are into, let me just flip to the weekly chart here. So weekly chart, there's a couple levels of resistance. I've picking this first level of resistance because you're on a 6 weekly time count into an overbought move. So you've had 1, 2, 3, 4, 5, 6 weeks of upside. You have this tremendous weekly gap fill over here. that I do think has a very strong probability of filling at the minimum. So that would be a beautiful decline right from our first initial short level. It would be an 18% profit in our name. But the fact that this stock has had 6 weeks of upside moves in a falling market, and when you factor in the type of business model that it is, it's consumer durables, vehicles. When you factor in that 90% of the vehicles in North America are bought via financing, and when you look at what interest rates are doing, interest rates are inevitably going to reduce the amount of applications and financing applications across the vehicle sector, because many people rely on loans to buy their vehicle, and if the prices of these loans are astronomically higher comparing a year ago, which they are about 100% higher, it's going to deter many buyers from the market, which is inevitably going to put a damper on their business model. And when you factor in that used auto vehicles and vehicles prices are one of a big weighting in the CPI index, and that's what is contributing to a high degree of inflation, it's going to be a focus for the Federal Reserve to get inflation under control, which inevitably is going to impact this company to a hard degree. So if it goes higher, our next short level will be at this 34. If it breaks through that, you have tons of resistance up here at the 38.75 level. But I do find it hard to believe that you're going to even break through this level, as this was a major capitulation candle. You can see on a weekly basis, it was a massive, one of your biggest sell side candles. Basically, you have to go all the way back to the COVID crash. So there's tons of resistance at the second resistance as well as the third resistance. But again, I have no problem accumulating this overbought name in an environment where this stock price is likely to get shredded. And realistically, this stock hasn't been through a tightening cycle. It's only been around since July of last year, or July of 2020, which I do think is when it entered the most speculative mania and pricing discovery that we have ever witnessed in stock. So I do think it has a long way to fall. And at the minimum, this gap fill is a key level that I'm going to watch. It would put us in the money tremendously, but we'll just have to wait and see how that goes. That's it for today. There's going to be many different things that I want to discuss. There's so many data points to discuss: crypto, gold, rates, the US dollar, overall, many different things in the real estate, lumber, other stocks. But I'm just going to leave this video because it is getting a little lengthy in time. But as always, thank you again for being members, and we'll continue to print profits and beat the average portfolio out there. We're not about preserving our wealth. We're about growing our wealth through this massive economic decline, and we just have to keep reading the markets objectively. We don't want to get tied to a certain bias, despite the bias right now being an overall lower trend. We have to realize there's still going to be bounces along the way as longer term capital comes into the play as markets get more and more depressed. But until the biggest buyer, which is the Federal Reserve, steps back into the market and starts monetizing debt again, we're not going to see all-time highs. That's pretty much one of the strongest givens in this market. So we'll continue to print profits. We'll continue to make smart executions based off of, firstly, key technical levels, and then secondly, the fundamental aspects behind it. But overall, please hit that like button, subscribe. Many investors are losing money and closing their investment accounts, and we are here continuing to print profits. We have closed so many winning trades this year despite the markets falling tremendously and the most amount of wealth being erased in this stock market decline and this economic cycle. But we are here. My portfolio has been performing tremendously well. We're up tremendously on the year when most people are down. So it just shows that as a nimble trader, you can still make money in one of the most difficult investing and trading environments that we have arguably experienced. And I read a statistic that this is the worst start to the S&P 500 since 1940. So when you factor in 1940 was 82 years ago. And when you factor in that people can only start trading at around 18 years old, this market that you can really draw. Sorry, they'd have to be 100 years old in order to be trading in this market. So Realistically, no one is 100 years old that is still trading. At least I haven't met that trader or investor. So realistically, studying history is the only guide to draw from. As experience, what we've experienced and what we're going through is a massive trend change in what has worked over the last 50 years. So we'll just have to continue to be smart, continue to use history as a guide, and continue to monitor central bank policy. Thank you all for being members. Take care and enjoy the rest of your